we continue to see, for example, a short to neutral duration as a more feasible strategy in the near term in terms of fixed income.
Yeah, you do see bonds as good hedges, right?
Yeah, a hedge against, strike a better balance between hedging against recession, even though it's not our base case, but then growth deceleration is still likely, and then growth momentum is gradually slowing down. And so this is a good good hedge between recession and also the potential fiscal concerns that may continue for the rest of this year.
Yeah, Marcella, as you know, though, I mean, the problem is not just slowing growth. It is also, we saw the Fed projections, right, on PCE overnight. They went from 2.8 to 3.1, which raised a lot of eyebrows, right? And I know on that, to that point, you still see a risk that crude could hit $100 a barrel?
Right now, it's pretty subdued, but then this is all depending on, for example, on various scenario analysis, like we'll closely monitor about like the Strait of Hormuz, whether they will see blockades in that end, because that actually control like 30% of the seaborne oil traffic and also 20% of the LNG. And so this will be a key signpost to monitor, and also how the whole conflict will evolve. But then actually geopolitical risks is not new to investors. But the key is that it's happening right now, when all the uncertainty and also that has been happening and ongoing with, for example, the U.S. administration, with the fiscal that we've been discussing all through. So that may actually contribute to further inflation risk. But then one thing that is different from previous geopolitical crisis related to oil is that right now, U.S. is now a net oil exporter. So yes, that may be still be a pain to like U.S. consumers, but then it might be a gain for like U.S. oil producers. So the overall drag to the U.S. economy may be less severe compared to previous episodes.
Marcella, I know you like European defense stocks, and we were actually talking about U.S. defense stocks yesterday and saying how there's been a bit of a fade recently, or actually since probably January 20th, right? Since Trump took office, simply because his appetite for continuing financial support to Ukraine seems to be not really there. Right, so that's why the fade in U.S. defense stocks, and conversely, because Europe is increasing defense spending, or is going to, a lot of money is rotated into European defense names. Is that why you are keen on European defense names as well?
Yes, indeed, and because of like a budget will be assigned to, for example, Germany, and for the next 10 years or so, they will gradually increase the proportion of GDP to be allocated to infrastructure and defense, and particularly to domestic providers. So this will be, previously we have always got interest into like European equities and also European stocks in particular. But then this time round, we feel like now we have more of a story and more of angles to like or be constructive on European equities, particularly this time around with the story on European defense, and potentially for the next 10 years, the development and evolvement of more infrastructure devoted to domestic defense sectors. So this is a interesting angle and interesting story that investors are more keen to hear about Europe. And also, for example, tilting more towards Asia, we see also, for example, Asia technology is also another interesting story that investors may continue to support for the rest of this year.